The IMF is changing its tone on global growth. It's raising its growth outlook for the first time in a year. Now, in its quarterly update to its world economic outlook, the fund now says it sees a turning point for the global economy, with GDP likely to expand 2.9% in 2023. That is about 0.2 percentage points more than forecast in October. While that is still a slowdown from a 3.4% expansion in 2022, the IMF says it expects growth will bottom out this year before accelerating to 3.1% in 2024. Now, the fund now says resilient U.S. spending and China's reopening will help to strengthen demand against a litany of risks. But, of course, central banks' interest rate hikes and Russia's conflict with Ukraine will continue to weigh on economic activity this year, and that's amid a protracted inflation crisis. Well, let's now delve further into that report with Liliana Rojas Suarez. She is the director of the Latin America Initiative and a senior fellow at the Center for Global Development. Great to have you on the show with us, Madame. Now, it is certainly good to now see that improved growth outlook coming out from the IMF. What are the key factors you think that have led to this change in tone from the IMF compared to a year earlier?
Thank you for having me. Clearly, there are three major factors that have changed the view. The first one is China's, the lifting of restrictions and the reopening are resulting in larger than expected recovery in China's activity. Before this recovery, the IMF was really forecasting that China was going to be slowing down much more than it has now. The second is the perception, the overall worldwide perception that central banks are really conquering the war against inflation, and that inflation is coming down, which means that interest rates are not going to keep rising as much as they were in the past, and this would lose financing conditions, which in turn is supportive of investment and growth. And finally, and very much related to the above, is the expectation that a world recession may actually not materialize. In some countries, include especially the United States, there are many people now talking about a soft landing, which means that the US could once again be one of the forces behind a larger growth.
But of course, Madam Liliana, you would agree that there still remain a number of geopolitical uncertainties. That's just the reality. That still remain a pretty serious concern for most across the world. So what factors do you think are a threat to that sustainable recovery that, of course, will be broad and also long-lasting?
Yes. Please, the key word here is uncertainty. It is really the most important element in all the forecasts. Please notice how much and how quickly forecast has been changing. Not only the IMF from its own forecast in October, but between economic organizations. Just 3 weeks ago, only 3 weeks ago, the World Bank had the equivalent of the IMF World Economic Outlook. It's called the Global Economic Prospects. And at that time, the mood was completely pessimistic. Okay, so it's really uncertain. I wouldn't be surprised that forecast would change again. So in terms of geopolitical uncertainty, there are, in my view, two major issues, right? In the short run, of course, the most important one is the war in Ukraine, right? Because of all the factors that we already know, the supply chain disruptions could accelerate. This has an effect on oil prices, which in turn has an effect on Europe, especially Europe. But in the medium and long term, there is another factor that is being brewing little by little, and this move toward deglobalization. We don't have time to talk about it, but deglobalization can be affecting a lot the behavior of world trade and finance, especially with the number of restrictions to trade, like tariff, protectionism, and in the case of finance, a move toward more decentralized payment systems that have been a talk of the day between China and other major emerging market economies.
Would certainly love to get into that. But on that note, I do want to ask you, how significant do you think monetary policy out of these central banks, both locally and internationally, how significant do you think monetary policy will be to a recovery? How much longer do you expect that we'll see that tightening cycle continue?
I think that the effect of monetary policy is extremely important and actually is hugely important, especially for emerging markets, particularly to those that are experiencing debt problems, which are many right now around the world. And it's not only because, the tightening of increasing in interest rate, tightening monetary conditions, and so the cost of finance increase, but it's also because it affects the willingness of investors to actually redirect more flows into emerging markets that are perceived as riskier. My overall views on tightening is that interest rates will be increasing at a slower pace now. Tomorrow, the Fed is going to announce, well, between today and tomorrow, is going to announce what is the next increasing interest rate by the Fed. And that is going to be, in my view, just 25 basis points. However, the European Central Bank is going to increase by 50 basis points, much more. My view is that the tightening, the increasing interest rates, is going to end this year. But I also believe that it's going to stay there for long. In other words, financing conditions are going to remain tight for emerging markets for a very long time from now on.
Now, the IMF report does point out that there are some upsides to this outlook. Risks such as a stronger consumption are currently more balanced than what we saw in October, are upsides to this outlook. What do you think are some of the upsides going forward? As you said, uncertainty is the top line, but what are the upsides?
Yes, exactly. When you have uncertainty, you have downsides and upsides, right? So, of course, a major one would be that the Ukraine war gets a resolution, right? Which is totally uncertain right now, but that would be something that definitely would change the mood around the world on how the world economy is moving. The second one is that financial conditions stabilize, right? That, yes, there is a perception, okay, we have inflation is coming down, and there is a more positive view towards the stability of the overall financial system and the concerns about major defaults or banking systems collapse kind of tempers down significantly. And the final one, again, very important for emerging markets, is that because there is an improvement in the overall conditions, there is less of a run towards the dollar. And so the US dollar stops appreciating. So that the dollar weakens, and that helps significantly emerging markets whose debts are mostly denominated in US dollars.